Well, I'm excited because just like 2008 at the moment, I'm 0% cash.
You're 0% cash?
Founder friendly has become bullshit, right? Any hot AI deal, there is no diligence provided, nor is any done. It's just done on Saturday. All you can lose is one extra money.
Having an early success is highly correlated with future success. Partly you get the referral effect, but partly I think it's that you just have the stomach to roll the dice and you get braver.
This is an epic monopoly like we've never seen. Think how much ChatGPT already dominates our lives. It's the Standard Oil of tech.
It's just this really weird dynamic. You've got this company worth $4.5 trillion with only 6 customers. That's bad news, but the good news is all 6 of them are determined to spend themselves into oblivion to win the prize. It's a fascinating game.
Ready to go?
Guys, I am so excited for this. We have a lot to get through. I even have graphs this week. I mean, this is like, you see this? This is it's intense. I don't know what
That's
they are.
That's how many GPUs you're buying from Nvidia? Is that what's 20 VCs commit?
It's up and to the right. That's all I see from this graph. Now, what else do we start on? Nvidia invests $100 billion into OpenAI. I wanted to start on this. Is this an infinite money printing machine where we have Nvidia invest in OpenAI, who commit $300 billion to Oracle, who then buy more Nvidia chips? Is this just a way to print money these days?
First of all, it's not an infinite money machine because it will end, right? The way I thought of it is on the way in thinking about this is basically Sam's going to get to make the bet he wants to make, which is apply infinite amount of capital and see how long these scaling laws last. And no one's going to call timeout until you actually hit a wall, right? Because what this says is Nvidia is going to get rewarded for, everyone's going to book gains. And if it all works, it'll all be good. It's like any aggressive financing strategy. If the underlying business works, everyone looks smart. The debt gets paid back, the equity goes up in value, and everyone's a hero. And if it doesn't work, it all comes back and bites in the ass, right? So what this means is, if it turns out that those set of OpenAI projections of, because $100 billion plus of revenue or whatever the numbers are real, we're going to get to find out because no one's going to call timeout along the way, at least for another year or two based on this, because everyone's getting, the capital is being made available and everyone involved is getting kind of mentally marked up. So that's my takeaway. They're going to get to find out here.
I have to intersect. You said there Sam gets to see if scaling laws do continue. I thought we all agreed that they didn't continue, and that's why GPT-5 was focused on efficiency, and that's why we actually didn't see improvements in the way that we thought they would. I thought we were already reaching that.
I think you got to listen. The one thing I've learned over the course of this show is to really listen to what Sam Altman says, because Elon Musk will say something and it happens. He's just like a couple of years off, right? But it always happens. The self-driving cars and the rockets, right? Sam says something and it happens like kind of soon, and he says it off the cuff, and he's sitting there with Jensen and Brockman this week saying, this is just a start. We need 3 orders of magnitude more compute than this. We need not 10 times as much, 3 orders of magnitude more, he says. And then he writes today calmly, and that just with this first slug, the 100 billion, hopefully we'll cure cancer and educate all students on the internet, right? There's a lot going on there. He's 100 billion. Then he said Stargate and we didn't understand it. Now he didn't just say 100 billion. We could talk about the round trip revenue. Is it really round trip revenue? There's some interesting questions, right? But he and the president said they need 3 orders of magnitude more than this to achieve what they're predicting today. Their goals. This is not Sony baloney. This is what they have on a whiteboard in a spreadsheet.
To be clear, I didn't say it was correct, Harry. I just simply said we'll get to find out, right? I'm not sure I believe that the marginal $300 billion will earn a return on capital at all, right? But my point is simply, there's some aggressive business projects where you go, I wonder, can we invest that? And you're just not able to make those investments, so you don't get to find out. And then there's deals where the market says, here, you can have the capital, have a go. This is one of those deals. We will find out. I mean, as the cliche goes, that's why they play the game, right? I'm somewhat more skeptical because I think the level of heroic assumptions you have to start making to make these investments all work is high. But the truth is, we're human beings, and we tend to, like, when someone is as astonishingly right as OpenAI has been over the last 6 years, it's just human nature to say, I'm going to continue backing this bet as long as it works, right? We're not, and what that means, by the way, is the consequence of that is it goes on until it stops. In other words, you got someone who's clearly going to keep doubling down, so the doubling down is going to keep taking place until the return on the double down isn't there, right? Is that now? Is that already happened? Is that going to happen 3 years from now? I don't know. I can speculate why I think no, but it doesn't matter what I think, is that the market has said, have a go. Here's 100 billion.
If you are Dario today, are you thinking, wow, we are in a significantly disadvantaged position as a result of this? And does this 100 billion move the needle significantly more in favor of OpenAI?
The question is, what is it giving you? It's giving you capital and access to chips. So do you feel constrained by those? You probably aren't constrained by a lack of capital. My understanding is they were beating people off with a stick on the recent Anthropic round, and if they decided they want another 10 billion, it'll be there tomorrow morning. So they're not capital constrained. So maybe you'd say it gives you some preferential access to GPU that OpenAI now has, but I don't know, right? So, I mean, yes, in the, oh my God, their capital is bigger than my capital wars, I think you'll feel the need to respond and do something, but it'd be interesting to actually pencil out what exactly, other than momentum and bigness, what problem you're trying to solve.
Well, Anthropic's not going to be able to build its own GPU like ChatGPT is. It's not going to be able to create hundreds of gigawatts of compute without that capital. It's not going to be able to build its own GPU. Another thing I thought through all this news, which didn't really come up in any analysis I saw. I was thinking about this a little bit. I'm thinking another thing that Sam is very clever on is towing the line on being a monopolist. OpenAI does not want to be a monopolist, right? Nor does Nvidia. They both want to be very careful in how they position themselves. I think Nvidia has an existential risk, which is everyone is trying to take their share, right? Google has its own TPUs. Amazon's trying, right? OpenAI is building their own to take away market share. But they both need to be careful. But OpenAI, I don't think they want 99.9% market share. I think they could be. They've already been through enough drama and trauma with Microsoft and throwing Sam Altman out of the company and bringing him back. They need their number two, possibly, or they're at risk, right? Because they might be a monopolist in some ways today at a consumer level. OpenAI.
Oh, right.
I use Claude every day, but you're weird if you use Claude, right? On the consumer level, they border on Google, Chrome levels of market share. And Sam's very careful to not denigrate others, right? Other than a few jabs at Elon, because he needs a little bit of this so that he's not ripped apart as a monopolist over time. This is an epic monopoly like we've never seen. Think how much ChatGPT already dominates our lives. It's the Standard Oil of tech.
I feel the need to cynically say that the objection to monopoly is the extortionate excess profits monopoly extorts from the consumer. Never have there in that basis been a less successful monopoly than ChatGPT because they're subsidizing. We'll talk about it later, an estimate of the consumer surplus delivered by ChatGPT in the tens of billions of dollars. So, to some extent, Jason, that was glib. I hear what you're saying. It's obviously not a cash extraction monopoly at the moment, but you're right. They have commanding market share in the consumer chatbot market, though I think between Gemini and Perplexity, I think they would argue not a monopoly. I think Nvidia, frankly, is far closer to being a monopoly in terms of market share than ChatGPT, which is why I thought you were going there. And I do think it's interesting. There's a whole bunch of people talking about building processors to try and take away that revenue, and I'm sure they're hyper aware of that. It would be fun to know what, if any, agreement was made on OpenAI making their own chips as part of this deal, right? It's hard to imagine giving equity to someone who's literally building when they're one of your 6 largest customers and they're building a competitive product. So that's a little something it would be interesting to know, but that, on the other hand, is a detail that probably will not be highlighted just given the dynamics.
Well, Nvidia is weird too because it has elements of a monopoly, but it has elements of a monopoly too. It only has 2 customers. I mean, it has a long tail of customers, but it has to make sure it doesn't only have 1 customer. It has a risk of only having 1 customer.
I think you're right. I think 6 customers I saw in the last quarterly accounted for something like 83% of the revenue, which is astonishing. First of all, let's step back. That's astonishing. Look at the market cap. They're $4 trillion market cap. Look at the 2 other $4 trillion market cap companies, Apple and Microsoft. Apple has 2 billion customers, everyone on the planet. Microsoft has probably a couple of 500,000 plus meaningful enterprise customers. These guys have 6. When you say it like that, it makes you realize, frankly, and again, I don't want to be the Debbie Downer, how single-threaded the market cap of the largest company on the planet is on the spending decisions of 6 or 7 people. Now, the good news for Nvidia, and this is why I go back to the consequences here, none of those 6 or 7 people look like they're blinking. You know, OpenAI ain't blinking. Google's made it clear multiple times. I saw a good quote, is it from Boko Capital, that, you know, just reminding us, Google have said over and over again, I ain't blinking. Obviously, Facebook, Meta has indicated an absolute willingness to tear up the book and do anything it takes to win. So, and Oracle ain't blinking. So, it's just this really weird dynamic. You've got this company worth $4.5 trillion with only 6 customers. That's bad news, but the good news is all 6 of them are determined to spend themselves into oblivion to win the prize. It's a fascinating game.
What's interesting for me is the revenue concentration expands just from these providers in this space to the data labelers as well. You know, we just had Macore on the show. 2 Macore customers make up 55% of the revenue. I spoke to the other 4 main providers. It's exactly the same. And it's the same 2 customers across them all. It's fascinating. They are incredibly promiscuous with their data labeling providers, and they just use all of them, and they are the 2 same for every one of them.
Yes, because that's the only people who want to buy this shit at scale. I mean, I always like to distinguish, there's the AI revolution, but there's the AI CapEx boom. I mean, there is an AI boom at the apps level. In other words, yes, adoption's taking place, but the scale of the real wow in the last 3 years has been just the fact that the CapEx boom, that the markets and these 6 deciders have been willing to let the CapEx get so far ahead of the revenue, right? That they've been willing to say, let's spend in aggregate 600 billion of CapEx per year on a market that today, depending on how you add up all the revenues, is yielding $30 to $40 billion in revenue. It's amazing. And anything co-attached to that CapEx boom has just killed it. And you're right, the data labeling, you know, which I'll be honest, we looked at some of those in 16 and 17 and we're like, is this a really great business? In theory, no. If you have a services business and you're only selling to 6 customers, you can make this intellectual MBA case that, oh my God, they'll get ground down on price. That case is totally wrong because those 6 customers don't have time to optimize. No one of those 6 customers is trying to optimize their cost basis. They're just trying to build as fast as they can. And if you're Mercer, if you're Surge, if you're anyone in the line of that, you're just picking up your dollars and stuffing them in your bucket as fast as you can.
It feels so nuts to me seeing $100 billion go into an OpenAI, and that as a headline. Rory, when you compare it to any other time that you've been investing, does this match any other time in terms of what? Holy cow, shock?
It's a good question. I think these analogies fall apart because the scale is so many orders of magnitude larger, right? The only thing that's different, that's similar, is the sense that it's unlimited, right? That it's unbounded, right? And we actually have more skepticism today than we probably did back then. Rory's skeptical of the limits here.
I totally agree. I think I'm not skeptical of the long-term trend. Does it feel like 99? Not complete analogy. History doesn't repeat, it rhymes. But it's more like 99 than anything else I've seen in the last 20 years, right? I remember, Nortel and Lucent making big vendor financing commitments to their big bandwidth customers to sell equipment, just as Nvidia is doing today. Though interestingly, Nvidia is doing it as equity, not debt. But I do remember that sense. Jason, you said it now, unlimited possibility. The future's so bright, you got to wear shades, and that just kind of endless belief. And I remember it also collapsing very quickly in 2000, right? Now, to your point, Jason, everything people said at the time was true. right? In the end, I actually still have the Mary Meeker book from 1996, 97 on my desk that kind of called, these are the big trends. Content, commerce, and collaboration, I think, were the big internet trends. And yet pretty much everything happened over the intervening 20 years. But obviously the time element turned out to be important. And there was like a 5 or 7 year period where the market had gotten ahead of itself and it was a pretty ugly retrenchment.
I mean, I think Harry's got a good point. This limitless potential, this is the first time we've seen it back then, right? It's not like other booms. This limitless potential. It's not the cloud boom when we were all locked up in our homes. This is a feeling it could be limitless. What's so different though in the Web 1.0 days is there just wasn't enough money. I mean, Amazon almost ran out of money after its IPO. Now, bless their souls, we've got all the leaders running around guaranteeing each other stuff. CoreWeave can now not go out of business. Like in 2000, CoreWeave would have imploded in months because it would have run out of money. Now Nvidia's agreed to buy 300 years of its capacity. Everyone's guaranteeing everyone. So this unlimited capital, yeah, of course, maybe it ends, but that's nothing like the Web 1.0 days. There was just no money. Okay, Nvidia, fiscal year 2023, $3.8 billion in free cash flow. Fiscal 2023. Pretty good, right? $3.8 billion. Fiscal 2024, $27 billion. Fiscal 2025, $60 billion, $100 billion or something the next fiscal year. That's a lot of cash to reinvest from your balance sheet. You should
say that.
Yeah.
Because I actually looked at the same number this morning, and yes, the free cash flow is $60 billion. I was surprised that, so that's obviously, to state the obvious, a lot of money. Again, the bear case. That's a lot of money and a lot more than it was 2 or 3 years ago. Right? In that context, I was surprised they have a buyback program. They've been buying back. They bought $9 billion of stock back last quarter. I would have, which is just interesting at this period in the cycle. And they've authorized a $60 billion buyback program. So in other words, there's a buyback program equal to the free cash flow for the last year, which is just interesting and aggressive. Cash on the balance sheet hadn't looked forever. It's $60 billion, which is a lot, but it's only 1.5-2% of the market cap, right? You kind of go and say here is that if this amazing market doesn't keep going just the way it's going now forever, then you could find yourself going, maybe I shouldn't have bought back $9 billion worth of stock at whatever it is, 180 a share. And I'll look back on that and say that might have been a mistake. And again, I find like I'm the doomer here. I'm not a doomer. I think the trends are great, but it's just a very fraughty time. And
you're right. In all fair, like I wish I'd done the math ahead of time. What I saw when I was at Adobe, which I think Nvidia is doing the same. It's not a brand new company, Nvidia, right? Is boom aside, they do try to buy back equal to the option dilution, the RSU dilution, right? It was almost 1-to-1 when I was at Adobe, right? So this is how you maintain your EPS at Adobe was by buying back everything equal to the dilution you give out in RSUs, which was just frankly a cash equivalent until the market boomed, right? It's almost a 1-to-1.
And flagging vigorously my opinion on that, as I've done when I've been on boards, I think the buyback the same as you're diluted is as dumb as rocks, right? You should buy back when your stock is cheap and you should sit on your cash when the stock is dear, right? I think the idea of linking it to your equity dilution, again, reminding us, we said we'd level up. Remind the listeners, lots of public companies, obviously they issue stock to their employees. And there's this ostensible rule that maybe you buy back in the market around the same number of shares as you've issued to stock to keep the share count constant. And as I said, you're right, Jason, loads of people do that. I think it's absurd, but what can you do?
It at least keeps your stock-based expense honest. Like if, a lot of folks losing money are pretending it's not an expense. If you're profitable and you buy it back, it's like, look, this is the same as cash. It's just a little bit of financial engineering.
Yeah, but it doesn't appear in the P&L. But
yeah,
but I think
for
the
sure.
fundamental question is this. Look, again, it's back to the zoom out comment is the same. In a bull market, no one focuses on balance sheets. We only talk income statements. And when things get tough, you're like, wouldn't mind having some extra money around. And stock prices that were high can be low. And typically corporations historically have a terrible record in terms of they typically buy back stock at peaks and don't buy back when it's cheap. And I see no reason why humans will change this time.
Ladies and gentlemen, study Larry Ellison, the master of this.
The master who exactly when it was cheap bought it all back and then used the capital to totally change the game to the current game of capex and investment and has made it work.
Rory, that's great, but what about me? Your favorite thing about chatting to me is I'm looking at my public book and I've got 28 holdings and 27 are green and I'm in the money, and I'm thinking I'm humble enough to know I'm not that good. And I'm looking at the S&P going, really? It looks like it's going to hit 7,000. You think it's going to hit 7,000 pretty soon, guys? And would you be selling now? And how do you think about when to catch the falling knife? Genuinely, like.
Well, I'm excited because just like 2008 at the moment, I'm 0% cash. Nothing.
You're 0% cash?
Nothing. I have no cash whatsoever. I had some cash. I have just like 2008. I remember feeling it was so great when the market crashed and I literally did not have enough cash to fix the roof on my house. I mean, I had enough stock, right? But nothing was more fun than selling my stock at a 70% loss or 60, whatever the worst of the crash was, to fix that roof. I remember feeling like such an idiot. Roof. And I don't have a cent of cash right now.
It's by definition hard to know. That's what the data says. So opining is all you know. Oh, look, you can throw out two factoids one either way. You know, the correlation on valuation and short-term return is pretty low. In other words, you can say stocks are expensive and the correlation on predicting 1-year returns is pretty crap. The correlation on picking 10-year returns is pretty good. At this current valuation, your likely 10-year return on the public markets is significantly lower than average because it's more expensive going in. Now, that's the long-term message, and that's a pretty grim message. And the short-term message is, oh my God, the Fed's cutting rates, blah, 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 things are going up. So, you know, what I do with that information, since you ask, is I accept that the cost of sleeping at night and having some portion of cash is accepting a level of underperformance, but you make an asset allocation decision based on what you want over the medium term, not what's going to optimize just in a bull market.
I'll tell you what the frothiest sign is. Well, one, we're all invested in Nvidia, right? To Harry's point, in the public markets. All our 401ks are in Nvidia. We're all on this ride together. But the frothiest sign is now LinkedIn. LPs are bragging about their returns on LinkedIn. LPs. When LPs start bragging about their returns, to me, that's the most 2021 moment I've seen, when LPs who are usually hide behind the Wizard of Oz curtain are bragging about their returns.
Dude, I have everyone in my Twitter being like, Hemont saying triple, double is dead is the top. So like, there are many signs that people think are. I disagree with that. I do want to discuss 75% of VC dollars in 2025 went to 19 companies. Is this just an extension of Mag 7 and concentration of capital? Is venture itself changing, where we're all doing a Kleiner Perkins and moving late stage to get into the surefire winner?
First of all, it's obviously a stunning fact, but a better way, if I may say, of thinking of it is not, has venture capital changed? It's that the 25% that's remaining is in fact the same venture that's always existed. It's, roughly, I think in our space, 1,000 something odd Series A's every year, certain percent will go to B's, and that business has stayed the same, plus or minus 10, 20% for the last 10 or 15 years, with fluctuations. What's really happened is, on top of that business has emerged this totally separate business called, as you say, ultra late stage, private public style investing. And I just think of that extra 50 billion a year or whatever it is added on top. It didn't change my business. It just means there's another business that you can choose to be in or not, that exists one layer up, one maybe two orders of magnitude above you in the valuation world, and it's still private. It's still quote unquote reported as VC. It's just a different business, and it makes sense that that's way more concentrated. You have, A is more concentrated than seed, B is more concentrated than A, C is more concentrated than B, because at every step some people fall out of the game. So the longer you hold private, the more concentrated it gets. In the limit, maybe we're just left with two foundation models and Databricks and Stripe raising a serious N or G, X or whatever it is, right? But it all makes quote unquote sense. It's just the way it's a different business than Series ABC venture capital. It just gets reported in the same bucket.
You guys have taught me so much, but one thing that Jason's always taught me is try not to predict out several rounds and just predict out the next round. And can you see a 3x there? And I really like that framing. We as a team do it. The hardest thing I find is, honestly, we are getting it wrong. a lot of our businesses now are growing nicely, and I cannot predict what the next round wants because it seems to be moving so much, and I'm having a real problem predicting financing markets. Are you in the same boat?
First of all, I'll go back to the rule. I actually think Jason's rule is a very good one. We've evolved to the same thing. You can have a high level generalized what this company can ultimately be worth theory of the case. But I think Jason's exactly right. It's far more useful to say to yourself, what does this, because you don't have visibility on 5 years, except at a macro level. But what you can say is, what's this company going to do in 18 to 24 months? And do I believe it can raise a follow-on round at a step up to our valuation commensurate with the risk? And that's a much more tangible discussion. And I think I'm sure, I'm not going to say every VC, but you evolve pretty quickly to realizing that's actually the right way to think about it. You sit there and go, if we do this round, and they make their treble, despite what you say, Hemant, will we be able to get a 2-3x step up in the next round? So it is a great rule because it's deeply practical, right? Much more so than forecasting long-term returns. Is the market fluky now? That's a different question.
Jason, can you predict which of your companies will be hot?
Not challenging you. I think it's always been easy when something is super hot to know it's super hot, right? When you have now maybe Hemant's right. Maybe the top 1% has changed, or the top 0.1%. Maybe we could be analytical about that. But when you're in it, and you can fall out of it, as we all know, right? But when you're in it, there's no doubt, right? What's weird today is that level just below it, right? Where it's unpredictable. Like, someone may see this as an outlier and preempt at a very high price, and others may see the risk beneath the surface, be concerned about margins, be concerned about churn, it's very easy to criticize a lot of these companies on churn and margins, right? And so if you're just below that, whatever that S tier is, that's where I find my ability to predict very, very murky, very, very murky. And then the one I disagree with you on, but I agree with you from Twitter, is I think the ones one layer above that, if they are triple, double, and you meet with enough people and you're not burning a lot, I do think you get funded. Like, that's where I quote disagree with you, but it's a lot more friggin' work. It's a lot more work to get funded growing 100% at 20 million or 110% at 10 million than it was 24 months ago. It's just a lot more work because you can't get the meeting.
I would just add one nuance. If you are in a slightly weird space that is traditionally unloved, like restaurants, or like no one likes selling to restaurants, as an example, it's a hard business, then where they would have taken a bet on you before with triple, double, now they're not. Now triple, doubles, growth, and you're in a space. They won't.
Or maybe, I think it's I would say the opposite, looking at owner, right? Which we know, right? Which is, as they have dominated.
Way more than triple, double.
It's faster. But then what my learning is, these models, like, if you're growing at outlier rates, you're an outlier. Like, I don't really care if it's tagging or at some, I mean, we all want it to be AI native, right? But if you are hitting those numbers, people don't even dig beneath the surface, do they? They don't even care if it's a lot of forward deployed agents or this or that. But listen, if you're the 11th undifferentiated restaurant SaaS struggling to build a point of sale at $1 million in revenue, people don't want to take that meeting, do they? At 50 million, 100 million growing triple digits, they'll take the meeting. There's only so many of those. There's only so many folks growing beyond triple, double at 50 to 100 million. They'll take the meeting.
I agree. I think that whole meme is a little overdone, right? The whole 3322 double, it's not good enough. Of course, there are examples of companies doing better than that. A small number, but a meaningful number of companies doing better than that, right? But that's not the only game in town. And I think that if you really have clarity on that kind of traction, especially at any kind, and some reasonable scale, right? I totally think you're getting funded. I mean, I think you raise a separate question. Is what's really going on a story belief? People don't believe that the growth will happen in the future. But look, I mean, you just had a couple of IPOs where companies are growing 30%. Obviously, that's at scale. So as long as you're on that kind of trajectory, I don't believe it's as vehement, as kind of sharp a line as some of the kind of Twitter thread, the Harry Twitter thread with Hemant makes it, right? Yes, there's a small number of companies growing significantly better, especially early on in the foundation models, but I don't think it's the only game in town.
But let's, for sure, look, it's sensational, right? We could break it down. There's a version of it I saw this week that was less dramatic, which was Iconic, right? And Iconic had $2 billion exits this week, Iconic Growth, okay? It had Netscope, which no one talked about, $8.5 billion exit. And they congratulated themselves on DX, which Atlassian bought for $1 billion, which I don't know how much they put in because they described themselves as essentially bootstrapped, right? So Iconic couldn't have owned a third of the company, right? But are even those rounding errors compared to Anthropic, right? It's just, they equally congratulated, but what with the fund sizes and expectations, do those meet the bar? Do DX and Netscope meet the bar in 2025 is a different version of Harry's question, isn't it?
Well, and as an absolute number, it's a great return. Let's start with that. I mean, again, you're right. If you have a $10 billion fund, you don't care, but most funds, those are excellent exits. I mean, we like Netscope, superlative company, did a great job, built a big business. Yeah, they are. Well, they are.
But do they count in 2025?
Yes, of course they count because they go on your bank account, and that's the mission, right? If you own 10% of Netscope, you have a $700 million equity position in a freely traded public stock. Maybe you paid $100 million for it. You have a 7x. It's great. It's a great outcome.
I don't think of this every day, but I do think about me and Emergence 2 back in the day. And Emergence 2 was an incredible fund, right? So many winners in cloud, right? The Vivas and all of those. And I was an asterisk at the bottom of the outcome. I was an asterisk. The returns were so gigantic. I mean, that was a 10x plus fund. I was just a rounding error in other exits, right? I just kind of think about who gets to be in the asterisk at the bottom of the DPI table in 2026. Because I was in the asterisk back then, and it's cool, but it didn't feel great to find out I was in the asterisk.
Interesting, but I understand what you're saying. But let's talk about multiple, and then let's talk about absolute amounts. Yeah. As the OpenAI cap table, quote unquote, crystallizes, right? I think some of the early investors in 2019, and I'm doing this from memory, based on their ownership versus the original capital in, it's around a 7 or 8x, right? So it's a magnificent company. It's the most important company of the last decade, right? But the actual multiples earned are really good. But so someone who did the Series A at Netscope also made a 7 or 8x. And in the end, now maybe the absolute sums might be different. You could put more money to work, but it's just worth pointing out on the basis on which, as an investor, as you invested in those, if you made those two bets, one of them being OpenAI from 2019 to today, and one of them being Netscope from 2017 to today, your IRRs might be different, but in both cases, you made a 7x. And all 7x's are exactly the same because money is fungible. That's why we invented it. There's very few ways to make a good return on a large amount of money, which is why the bigger the fund size, the more you have to be in only 5 or 7 deals. But there's quite a lot of ways to make meaningful equity returns on good outcomes. $5 billion plus IPOs can result in a perfectly great 10x. So and Evan's going to cash the check. So I'm here in defense of none of those are boring, and there's more ways.
I find that scary listening to you, Rory. Sorry, a $5 billion IPO does a 10x.
Well, again, by the way, it's not a 10x on the Series A. I'm actually just doing it because I calculated, I'm not going to name the investor. I calculated one of the investors because a lot of them, very wisely in my opinion, have piled into the follow-on rounds. So your return on your first money is a 25x, your return on the last round is a 3x, blended across everything, you have a 7x. So, but it's a 7x on 100, 150. If you want to talk about the return on the Series A, my guess is it's 25, 30x at least. It's a great return.
But it is also a company where 10% of the world's adult population is a weekly active user.
Oh, we're now going back to OpenAI, the other 7x. Yes.
Fuck. Yes. 10% of the world's population is a weekly active user.
Yes. Yes. So we're now switching from, as it were, the 7x in the mid-sized tech-centric IPO to the 7x that you get investing in OpenAI. Yes. Your return might be only the same, but obviously it's a company of far more stature and significance. Just taking women capital to get there.
If you had a large position in OpenAI in the fund now, would you be selling, Rory?
I think you'd have to think about it, wouldn't you? I mean, I think you'd have to think. I mean, if you're not thinking about it at 500 million, you're probably just not thinking.
I completely agree with you. It's another, you mentioned DX.
I don't think anyone's going to sell. I mean, Iconic was saying they never got more calls than they got trying to get into the Anthropic round. This last round, they never got more calls in the history of Iconic than from their own LPs wanting to get in, right? So I'm not saying you shouldn't sell. I'm just saying, boy, it's hard to be sitting up the fund and sell when you've never felt more strongly there's another card to play, right? I mean, the easiest thing in venture in the world is if OpenAI goes from 500 billion to $1 trillion and you don't have to take a single meeting, right? You don't have to show up to anything. All you have to do is open an email and your position doubles. I mean, it's so hard to say no. This isn't like Rory's point. I mean, look, what 80% of IPOs trade down, right? So that's a tough bar as it is, right? But when you've got one like that in a frothy market, how do you sell?
I don't know, dude.
On paper, you can, but in the good God, I mean, the three of us are each going to make 50 million now. But if we just wait 6 months, we can make 100. 100. And I got to pay taxes. I mean, I'd rather let it ride and defer the taxes on I can't even, again, there's really only so much I can get on the Yellowstone Club for 50 million. I mean, after taxes, I'm sort of mid-hill and I'm probably under 3,000 square feet. And I don't even know about the radiant heating. So let's play another card.
I think the level of money. No, but Joe's side, I think you're right, Jason. I just think the level of money you have going in dictates your willingness to sell. Again, we're very candid and we're friends now, which is great. But I don't have $50 million, and so I would absolutely take it off the table because it's really meaningful when it's your first big hit.
Agreed. It absolutely
but there's
is.
also weird dynamics too. Rory could educate us the most. This is what I think about is turns of the fund, right? If you have a smaller fund and you have a fund returner, it's a weird dynamic. Because all the internet advice says a fund returner is what you want to do, right? But turning a fund returner into a 2x fund returner is a BFD. It's such a big deal for carry, for performance, right? That's where actually, that's a nice but stressful position to have is a 1x fund returner with liquidity options. What do you do?
And I think I like the layout because I think you have to go out. It's a two-step think process. First of all, you have to come to some kind of opinion on fair value and upside for the stock. I mean, you have to have some level of fun. It can't just be it's going to double because it's always doubled. You have to have some grasp of the fundamentals and say, what do you think this is going to be worth? $500 billion makes it the 15th largest market cap company on the planet. It can go from here, right? Whatever, right? But then I think the interesting thing you're saying is then you have to overlay on that the institutional or personal imperatives that come on top of the raw expected return. And plugging a book, I recently reread actually a book called The Missing Billionaires, which was written in part by Victor Hagani, who was the youngest partner at Long-Term Capital when they went spectacularly burst in 97. He's gone on to a career in wealth management. Truly excellent book. One of the best books I've read on portfolio management. The comment at the start is, Cornelius Vanderbilt died the richest man in the world. If all his heirs had done is stuck it in the S&P and lived on the dividends, there would be 15, 20 of them each worth $1 billion today, and there's none. Because he says people screw up bet sizing, they screw up portfolio management, and it's not about stock selection as much as it's about the things you just mentioned, the institutional decisions. How much of your wealth should you have in one stock? What should you do with a 1x fund that's liquid where you might see potential to a 2x? How certain do you have to be that it could double again before you should leave all your net worth in that stock, right? And it's and you actually ended up convincing me of kind of the marginal, it's what Harry effectively mentioned, the marginal utility analysis. You do have to take into account your risk aversion. And we're not all just trying to maximize expected return. You should have some level of risk aversion. And the question is how much? And as Harry said, when your risk aversion relative to the bet size changes with your net worth, if you don't have 5 million and you have a liquid 5 million, you probably should take that 5 million. And then how that changes over time. Super well written book, quite quant at times, but for exactly these kind of things. And you end up, the meta conclusion I have is that most of us have a risk aversion of about, as he quantifies, about 2. In other words, you're not going to let the bet ride for equal expected return. And that's most normal human behavior. And then the second conclusion I have is some people, I lump Elon in that, are just totally maximizing expected return. There's literally no risk, zero risk aversion in the system. They just want to make the bet. SBF had the same thing. He would do a 51-49 bet. It's like some people just have super high risk tolerance to the point, arguably, of insanity. And those are the people that make great entrepreneurs. Most money people will take some money off the table.
Do you think investors are like founders then? Where as we say, hey, take secondaries, take all that stress off the table. Do you think richer investors make for more high upside investors? Because they're like, fuck it, let it ride. Sequoia aren't here to make a half a fund return. Whereas an emerging manager, oh shit, I need a half a fund return in DPI. I need DPI. That may be...
I think at the margin, it's almost certainly true in the sense of, I wouldn't want the emerging fund manager to totally, to behave irrationally or just over-optimize on the thing. But there's no doubt that a significant part of the advantage of a firm like Sequoia has is just the innate belief that something else will turn up tomorrow. I don't have to fiddle around with this at the margin, right? And there's a bunch of stories about that, I believe. And again, this is apocryphal. I wasn't in the room. I believe the early offers on YouTube were significantly lower. And the Sequoia guys were like, no, we're not just taking that. And the offer went up. In retrospect, given they sold for $1 billion and it's probably now what, $100 billion, you wonder. But yes, the ability, there's no doubt that success begets success, not just for all the referral effects that we could talk about, like, you get to see good deals because you've been successful. But there's also this very intangible effort thing, Harry, that you mentioned, which is people who've been successful are more willing to take risk. And the only way you get success is by taking risk, right? There's a reason that, they've done all this work that one of the interesting venture it's hard to correlate venture success with a whole bunch of things, right? Education, stage, blah, blah, blah. But it turns out having an early success is highly correlated with future success. Partly you get the referral effect, but partly I think it's that you just have the stomach to roll the dice and you get braver. Now you can over extrapolate that and screw up, but there is no doubt that it's a lot harder early on to have the big cojones to roll the dice. And if you're Sequoia, it's probably a lot easier.
We say about risk return analysis, concentration of assets. I hope it's okay. I hope he doesn't mind me saying this, but Oren Zeev, a lot of concentration across funds in Navan. And at points that has looked very, very nerve-wracking. Point being when it went to zero in COVID. They announced, obviously, they're filing their S1. I thought interesting elements, 613 million revenues, growing 32% year on year, 10,000 customers, 110% NDR, which is good. Not best in class, but good. How did you guys think about this S1 announcement?
Well, before we talk about the S1, let's go back to Oren Zeev. Well done, Oren. Good guy. Exactly. Think about it. You made a very non-diversified bet. It's terrifying. You then, let's all remind ourselves, you then had COVID in your travel company. Your revenue probably went to zero in March of 2020. And to go from there in a non-diversified bet to having an S1 on file for a perfectly doable, nice IPO, I can imagine the exhale when this puppy prices. So well done him and his investors.
You guys are better experts than me. Is it really as concentrated as it sounds? If these are SPVs and opportunity funds and other things, is this him really putting 80% of a main fund into Navan, or is this stacking a whole bunch of vehicles?
I have no idea.
I have no idea. Bluntly,
it just may not be as it may be a lot of his book, but it may not be as concentrated for his early stage fund as it sounds, right?
But 20% of a fund, dude, is a lot, and 20% across
I don't think it's a lot.
Funds.
I think you got to put, if you have a small, how big was his core fund in that, right?
Do you have 20% of your fund in any company?
That's yeah, I'm a pretty concentrated investor. So I'm going to get to 10% almost in 2 checks into any deal. So yeah, I don't think it's that, because if you have 100 bets, it makes sense. But if you have a breakout winner, you should put 20% into your winner, right? I think 100 is risky. I don't think it's going to because Rory can help me do the math. Once your fund is up 4 or 5x, 20% of the initial principal is not that much of your NAV.
Yeah, once you're up.
Once you're up.
These are all trade-offs. Concentration results in, can result in increased outperformance at significantly more risk, right? And the question is, again, are you getting paid for that extra risk? I don't know if I'd have the stomach to put 20% in one deal. And I want to honor the fact that Jason clearly and, Founders Fund, in my view, one of the most successful firms, have the stomach for that. And maybe it's just a risk tolerance perspective. I'd find 20% hard.
Brian, I'll give you a learning I had for what it's worth from Byron Dieter, right? Yeah. So I forget exactly how it works, so I'm mixing up a little bit. Harry just had him on his show, but there were like X number of partners, okay? And each essentially were allocated a tenth of the funds or a sixth of the fund nominally. And Byron put 30% of his into Twilio, roughly, okay? Now, that wasn't 30% of Bessemer 9 or whatever it was, but it was 30% of his career in that fund, right? So is the math really that different in that sense, right, for the GP?
It is, because for the GP in question, no, but for the firm, I mean,
for sure.
Yeah.
But it's similar, but it's a similar risk at the GP level, isn't it? Putting all of his chips into Twilio?
Yes, it is a similar risk for him, but it's not, but it's not the risk his investors want to undertake at the fund level. So fine, in other words, it might be fine for an individual GP to have 30% of their book. Look, it's the same reason, step back, guys. It's why these macro managers, best business on the planet, by the way, have these little pods. Each individual pod is taking wild risk, and then the macro manager is sitting back, and basically anyone who underperforms by, more than the tolerance just gets whacked, and you put a new one in, right? So you get the person on point is taking a lot of risk and a lot of upside and a lot of focus, but there's always this intermediary layer that's saying, I want a little bit of risk smoothing out and risk management. And I do think most, not all, but most investing vehicles have some element of risk diversification in them. There's very few people, there's not a huge appetite in most markets for undiversified single stock risk, which of course, interestingly enough, there is right now in, as you say, the Anthropics and OpenAIs of this world.
I always remember Brian Singerman teaching me that capital concentration limits are the enemy of great venture returns, and that's why they have 33% of their fund in Airbnb. Now, I don't have the balls he does, sadly, otherwise I'd be much richer, I'm sure. But I always remember that. On Navan, point taken, Jason, in terms of level of concentrations.
And I'm just going to, before you go on to Navan, I'm just going to make a comment back on that, citing the book again that I read. It was really interesting because it made you run the exercise of what level of confidence would you have to have in the excess return from an individual stock to put all or half or a quarter of your net worth in it versus having it in the S&P as a whole. It quantifies your certainty level, right? And one of the exercises it did was to say, how certain would you have to be that Tesla is an outperformer to be 100% Tesla from the 2010 IPO on? And the answer is you have to believe it's about a 70% outperformer on the S&P, which interestingly is about where it ended up, right? So you can quantify these things. So instead of just saying, I'm going to take risks, you say, how certain are you that this stock is going to do 20% better than any other stock in my venture portfolio? And if you have a high degree of certainty on that, then you skew your concentration. But you have to have some rule of thumb like that, rather than just, I feel brave, let's do this. Enough of that. Sorry, now back to Navan.
It's a meaningful company. It's been a very prominent startup for the last few years. Anything notable that you thought about the IPO?
Well, can I ask both of you, maybe Rory first, a question on it? Maybe this is a little mean, and I'm a big fan of RL and everything they've done, right? But it feels like to me, and sometimes this is a good IPO strategy, is they're going first. Because look, Brex just announced, and Brex had its slowdown, right? But it just announced it's growing 50% at 700 million, right? Hard to take everything at ramp. It's a little confusing, but let's assume they're growing that faster at $1 billion. Okay. They have to be mathematically. So if you see them as peers, and we could argue they're not, but I think the markets will, it's number 3. There is an argument that number 3 should go out now before number 1 and number 2 are out and the public markets lose interest. I don't know whether it's true today, but when I've been on the other side of IPOs, there's a strong desire to get, if number 3 is good, right, or number 2 is good, to get it out before number 1.
Two things. One is, I think they would say, and in my view correctly, that while they're in adjacent spaces, Navan is very much trip and travel focused with a small amount of software. Brex is very much card with a small amount of software and payments. Same with Ramp. And then Bill, which I was on the board of for years, is very much accounts payable with card. So they get lumped in the same thing, but they're actually quite different. And most of Navan's revenue comes from business the other guys aren't in, which is travel booking, as distinct from travel paying.
Yeah, almost all of it, right?
Right. Travel book. So in other words, when I book my flight on the Navan system and I book United, that's Navan money. Now, if all I do is pay for a flight on United Airlines with my Brex card, that's Brex money. But they're adjacent spaces, not the same, just to put that out there. But at the same time, but I can see you're right. When you zoom out a million miles and when you read their S1, they're clearly trying to claim more than just travel, because they're really trying to claim payments, they're trying to claim software. So based on their claims, which are a little in advance of their reality, you're right. They are in the same market as those other two. And if they are, it's pretty damn smart to get out early.
I think that expansion across the horizontal product suite, I think, is actually behind the rebrand from Trip Actions to Navan, going from vertical specific to horizontal. And I agree that Travel Perk, I think, are obviously a very direct comparable for them. And they are, bigger than Travel Perk. I think it's perfect. If I was the board, I'm like, perfect timing. Let's go. Completely agree with you.
But this isn't the best time for Navan to IPO. They're not profitable. This isn't the best time. I think they're doing it because of, listen, I could be wrong, and I'm a fan, right? But I think they're doing it because of the competition for IPOs. Otherwise, why not wait another few quarters and get profitable? Because it's not I don't think it's the perfect time to IPO.
I don't know though, dude. If we were sitting on the board together, I would argue with you that Ramp and Brex are not going to go out anytime in the next 6 months.
But my experience is create that gap, right? I mean, you could argue that for at the lay level, Netscope didn't get much attention because Rubrik is the same but better. Now it's not the same, okay? But if you're just comparing security IPOs, Rubrik is growing faster with better economics than Netscope. Why? Wake me up when you have something better than Rubrik. Wake me up.
But you're still getting $7 billion of liquidity, right? I mean, I think the problem is
for sure. Yeah.
So, I mean, first of all, let's consider this on a standalone basis. Getting liquidity, and then we'll do the game theory of the other guys, because those are different questions. On the standalone basis, yeah, you're right. Probably, I mean, I can see the pro and the con. If you wait another year, it'll probably take more than another year to get profitable. Because if you actually look in the P&L at Navan, right, they really held OPEX flat to, in fact, slightly down this year versus the prior year. And you do that as a board when you're like, you want to throttle the damn thing and make it profitable. So you really push. And remember, inflation's 5% or 4%. So if you're running negative OPEX in real terms, you're really reducing. So this is a company that's clearly is straining might and main to get profitable. Right, and you're going 30%. So you could probably work out based on that, is it 1 year or 2 more years to get profitable?
It's too long then, right? Growth. It's just too long.
Yeah, and you say to yourself, I could wait, but this is a pretty damn good market. Do I take a little haircut for not being profitable yet? But am I done now? Am I public? It's off the to-do list. You survived the near-death experience 4 years ago. And, as we've discussed, we think at the margin, public security is just an easier place to be in terms of access to capital on an ongoing basis. So I think it's smart of them. And you're right. So you have that in the abstract. And then you have the game theory side of it, which is it's good to be first, maybe, but you definitely don't want to be last. I mean, because the other side of the thing is really hard, where two other companies get out roughly in your space and you're the third. At that point, unless you are demonstrably better than them, it's actually it becomes troubling to get out, because every public investor says, I already have Brex and Ramp. Now you're Brex and Ramp, but not quite as good. Why would I buy you? Right? So you often don't want to be the last one out. You don't want to be the last player and the last one out.
When people perceive it as a direct comp, even if it isn't, it's just like, I'll just go buy if Brex and Ramp are already public and they're better, I'll just go buy those shares today on E-Trade or whatever. Why do I need to do your IPO and listen to your roadshow unless there has to be a massive discount, or why do it, right?
Yeah, no, which would argue what you're saying, Jason, is it might be smart to go now. It might be smart to get the novelty value. It might be smart to take the ground. Maybe you can go public. Maybe you can, I don't know, acquire a second string card payment company and add that, arrow to your quiver. Much easier to do as a public company. So yeah, I think it's smart. And
Rory,
good on.
I haven't had IPOs like you, IPOs period, actually, for that matter. So I have to ask, you always get these newspaper articles that are like, oh, index make $5 billion and big numbers thrown out, but you've got a lockup period. And then as a major investor, you can't sell all in one. How does it actually work genuinely when you are a large shareholder, they IPO? What's that timeline to liquidity?
Sure. First of all, yes, it is. It's a totally funny thing because the other thing, just to put it out there, just say it is that, you tend to report as an investor your holdings. You're the named person on the thing. So in SEC filings, it looks as if you own not just your shares, but your partner shares and the LP shares. So suddenly, let's take the index example at Figma. You can probably Google the partner and index and they'll say net worth Figma stock $3 billion. It's totally misleading and results in a whole bunch of charities calling you and saying, please give me some of your $3 billion. And you're like, I don't have $3 billion. I got 20% of $3 billion divided 5 ways and it's like 6 months before the lockup. So yes, you do get that effect, at times. Yeah, it's just a process of time. You have a lockup most of the time. One of the attractions of direct listing is you don't. The lockup is typically 6 months and they can be waived earlier. Sometimes you see these performance triggers where if the stock trades above a certain amount, you can waive the lockup early, which is nice. And then after that happens, the next thing is the other thing that sometimes happens is in the lockup period, if the stock performs well, right? And by performing well, it means, trading well above the IPO price, which gets back to this whole thing of IPO pricing. If the stock, quote unquote, trades well, you can probably get a secondary done, which means that you can sell more of your shares in the lockup period via a registered offering, right? And that's attractive because it's liquidity in a structured deal where you just get your capital, right? And it's one of the reasons why, it's one of the reasons why at the margin, a 10 or 15% pop on the stock isn't, quote, the worst thing in the world, because everybody who buys at the IPO is happy. And then 6 months from now, if there's going to be a secondary, which means a structured sale, you can't get a secondary done if the stocks trade down. If you go public at $14 a share and 6 months later you're trading at 12 or 10 or 9, it's extremely hard to get a secondary done. Whereas if you go public at 14 and it trades up to 18 or 19 and you make your first quarter, then you can easily get an IPO, a secondary done. That's the second way out. So you end of the lockup win. And then other than a structured secondary, your choice is distribute the shares to your limited partners or sell. And the truth is it takes a lot of time, especially if you're on the board. You have reporting obligations. You have quiet periods where you're not able to sell, and it takes a long time to get out of a position. Typically, 18 months from the IPO, plus or minus, maybe 24.
Is it not just better to sell before in a pre-IPO secondary?
No, probably. Not all the time. Again, you have to have, it gets back to the same two criteria. You have to have an informed opinion on the value of the stock, and then you have to figure out your risk tolerance and institutional kind of issues on top of that, right? But look, to the extent that the median stock pops and then trades up, you'd probably be leaving some money on the table. But there's been times when that's been the right call.
I asked Hemant in the show, do you believe that you are fundamentally a better manager of public stocks than your LPs? And he said, no. But we do understand that there's some who have this rule that they have to systematically sell the minute that they're distributed to. And so in that situation, we will deliberately hold on, because we're not saying we're arrogantly better, but they have this systematic, bluntly strange rule in certain cases, or ineffective in a lot of cases, where actually they need to hold on. I thought that was interesting.
And he's broadly correct. Some LPs choose to automatically sell. And the logic is, look, they're inheriting a stock they don't know anything about. The person who knows most about it, which is the GP, has elected to distribute it. So there's some signal in that. And it's just not the asset they want to hold. So I get the logic of the distribution. Right? I get the logic of the rule.
Hold is your best time to trade on, legally trade on inside information, though. If you're on the board or close to it, it's your best time to trade on that illegal information by not trading.
By not trading.
Yeah, you can hold legally with inside information. It's a privileged position. You can sit on that board and know what's coming next quarter and tell no one and hold. Now, you got to be careful if you distribute or sell. You have to be a little thoughtful about your timing. But you have this special thing where you can hold on inside information.
Yeah, you're right. There's no securities law violation on holding. Equally, just to say it, though, the kind of is, if you have negative information, you absolutely can't sell. So it's not it's not a one-way win street. But you're right. One of the interesting examples, I remember one case of that where on a public company I was on, those were on 6 or 9 months where we were in active M&A talks. And, you'd have your LPs ask you, why don't you sell this stock? It seems very fully appreciated. And, you can't say a word. You just have to say we're taking everything under advisement. And you're sitting there knowing we're about to get a 30 or 40% premium once this deal closes. So yes, you do have that. Because it's a great point, Jason, because sometimes LPs ask, in my view, correctly, what's the advantage of being on the board once you're public? And, there are disadvantages, right? But it's not a one-way street. The disadvantage is limited trading windows. But the advantages are you do have an inside seat on something like driving to an M&A or an upside outcome, and you have a better sense of the company's performance. So it's a toughie. You err on the side of, I find you err on the side of getting off reasonably quickly because, you do want to get on to the next business. But I don't, on the other hand, believe in just bailing day one. So I've generally found you get off within 12 to 18 months of the IPO most of the time. And at that point, you're distributed. You've done your job. You shouldn't just be on, for other reasons. That said, it is worth pointing out that the two venture investors in the Nvidia IPO in 1997, Mark Stevens and Tench Cox of Sequoia, have stayed on that public board to this day. And I believe the board packages, the equity you get as a board member has been extraordinarily worth their time. Let's just go with that. Extraordinarily so.
And there's one I totally can't remember, so I'm not even going to try, but who's never sold a share.
Yeah. I think it's Mark Stevens who never sold a share. I think, yeah. Yes, that's good. No, you're probably looking at $1 billion plus, maybe many billions of dollars. That's good. Yes. It turns out being in the best, being early in the largest market cap company on the planet and never selling any shares turns out to be a remarkably good way to make money.
I think it's impressive, but just like the concentration in Navan, it's just a hint less impressive than it sounds. It's very impressive, right? But when you're up enough personally, it makes sense to hold all your winners in the public markets for taxes and other. There's just no reason if you're personally up enough to sell any winner, right? With all reasons, you might as well let it ride, right? Unless if you know it's going down, sell it, right? But you want to hold on to an asset that will continue to appreciate essentially tax-free. There's a lot of advantages to it, right?
Pointing out that portfolio theory would say something different. I emotionally, I'm with you. I liked holding on to the companies I'm involved with. Portfolio theory would say something different.
I'm not breaking the rules here. I don't think. You can tell me if I am, but it's a very significant part of our ecosystem. And I mean it directly applied to tech. I'm not going into politics, but H1B visas was announced in terms of the $100,000 fee or payment that's needed now for new H1B visas to be granted. So I'm not going into Trump or politics very deliberately. Do you think this will have a material impact on startups, early stage companies, and the teams they build?
It will have an impact. It will obviously at the margin be negative, right? Because at the margin, immigration has obviously been extremely good for the tech ecosystem. So you can make that as a definitive statement, right? You ask material is a harder thing to assess.
Well, there were 440,000 applications in the last year. They generated between 90 and $120 billion of GDP for the US.
Yeah, I mean, 70,000 accepted. I think there's 75,000 a year, one or the other, right? And yeah, I think at the margin, if you were to have any rational immigration strategy, and you were to rank order the people you want to let into your country, STEM graduates who found companies that employ thousands of Americans would be top of that list, right? You could argue that some higher fee, some program like the exceptional program we have, which is separate, or the H1Bs kind of makes sense. You could argue that some increased fee might mitigate some of the arguments against the H1B, which is, some folks would make, which is that some of the applicants are at least doing much simpler work that could be done by folks in the country, and therefore, hey, maybe it should be charged more than that. I think the way this has been implemented, the absolute sum, all those things aren't great. And I think the real truth is rational immigration policy for something like this gets caught up in, as you say, a whole swirl of other emotions around wider immigration issues. And what it means, it seems to effectively preclude any sensible, rational policy on, for this kind of highly skilled immigration, when it's pretty obvious that, that a rational program like this would be extremely good for the US.
Well, look, I think anyone that has been doing this for a while, that isn't just three kids working 996 in SF, has had H1B folks on their team. I have. I've had great folks on my team. Especially my first startup, which was hard. It had a material science component. It wouldn't have been possible without H1B, at least on its surface. Okay. I had H1B. I had two folks with H1Bs they were transfers, right? I didn't sponsor them. I had them on my first team of 10. I had two. Wouldn't have had my first exit or my first startup or saved hundreds of more of lives from my first startup. So can't, for sure. Right. And what we want at a meta level is everyone great coming to the US. That's what I selfishly want. Every single talented person that can help keep our Nvidia shares high flying coming to this country. I want it selfishly and ethically and personally. So it sucks, right? But I do say, but at a very tactical level, we find ways, okay? The O1, like, if you look at the companies you've invested in, they're all O1s now, okay? Everyone finds a way to get at least all the founders get O1s. And O1s have a lot of cons, right? And you've got to keep them going and it's stressful, but there's ways. And so I do think the impact will be modest and the big tech companies will just pay up, right? But I think it's terrible. But I think the impact will be modest at the moment if it doesn't expand. But We've all had great H1Bs on our team. It sucks.
Exactly the pragmatic point. If you're willing, if you see the strong, I appreciate you saying that, Jay. If you see the strong positive that the program brings an aggregate, you could say there's a little bit of abuse, but it's worth the tax. If you're on the outside and you're incensed by immigration in general, then you ignore the great people who've been enabled by H1Bs and you focus on the abuse and you say, this is awful. Pick a company. Microsoft is using H1Bs while laying off Americans. It's easy to give that speech, right? There's no accident that the countries that have the most skills-based point system are the countries that have least angst about immigration. $100,000 is kind of a rough American proxy for skills-based. In a rational world, you do what, let's remind ourselves, what Trump at one point said he'd do, which is attach it to every STEM degree, right? You're trying to find some proxy for let in the people who are best for America, right? That seems to be a reasonable rule, because let's be frank, everyone wants to get to America. God knows I did, right? So you have to have some rule that isn't everybody. So a logical rule is what's good for us. And you could imagine a point system, STEM, all that kind of stuff. The money thing is just I think it's trying to be a very crude proxy for that. And I think, with people being more cooperative, you could probably come up with a better scheme than pick a dollar sum and make that the deciding factor.
Final one before we do a Kalshi quickfire. It's just Notion hitting 500 million of ARR. I thought was really impressive. It's
and accelerating.
So, okay, I'm going to say it then. Harry, they're not doubling, right? Is it impressive? I mean, I think it's impressive, but this is almost a counterpoint to the, only thing that matters are things growing faster than SaaS. This is a mid-sized SaaS company. We excel probably, 30%. It's great.
Why did I think it was impressive? I think it's to Jason's point. It's hard to get a re-acceleration at scale. I think treble, double is absolutely dead. Early stages.
Agreed.
Treble, double at hundreds of millions in revenue is phenomenally impressive to me.
Agreed.
And at 500 million in revenue, you could actually squint and see my $10 billion stock, which I have since it acquired some of my companies, reasonably being finally up to the watermark of $10 billion. I'm like, 20x. It's a bit punchy. It's a bit punchy with that growth
those
rate.
Pesky 2021 valuations.
Jason, $10 billion.
Klarna doesn't even talk about it anymore.
I mean, what it points to is, reports of their death have been greatly exaggerated, as Mr. Twain would say, right? It turns out these mid-tier significant scale SaaS companies, they don't have to just become something totally different, but they have to embrace and lean into the AI trends while still being fundamentally the thing they are, not trying to be, a totally different company. And you can get, re-acceleration. And I agree with you. I was giving you shit, but you're exactly right. 30% acceleration at $10 million isn't what the paper it's written on. But if you're at critical scale, within striking distance of an IPO, and you can use kind of an AI-enabled story to get you back over 30% plus 40% growth, you have an IPO in your future.
They IPO today. Where did they price?
Well, we can tell because, crudely estimating, I don't know if the growth rate, but let's assume it's 30, 40%. I doubt it's really doubling. I could be wrong, but just looking at the head count, they have 1,200 odd people, which probably 200, which doesn't get you to doubling based on the growth rate. A 30% grower, Netscope and Navan, Netscope is priced already. It's 7, 8, 9 times NTM. So something like that, 4 or 5 billion. Maybe more if the forward growth rate is a little better or if I'm underestimating the revenue. But yeah, a long way from 20 billion. And it'll be interesting to see how they digest their preference issues. But a great outcome. $5 billion, $7, $8 billion is real money.
No, I know. I got in at 10.
Well, I don't know if it works. That's your problem, not theirs.
It's not my fucking problem. They bought my company. I didn't have a choice.
Well, it's a little bit. It does hang over the heads of most founders. The high valuations. They've compartmentalized it, but it's not. It's a little bit their problem.
It is their problem. And as I said, the real question then is how does it get out? Playing that out, how does it get unwound? And we talked about this in the context of a couple of the prior IPOs. I don't think you should stay private just to earn your way back into $20 billion. I think you can go public. And then I think it will boil down to, you might go public and either the stock gets converted or, as we've discussed, the preference remains outstanding until it grows into it. But yeah, I don't think you can hold the rest of the company up just because 5% of the company paid 20 billion pre.
Do you think Airtable will make it back? I got a ton of Airtable from them buying a load of my companies again. Just help me out. Just help me with my planning.
All these companies are going to be priced on the fundamentals. This does go back to maybe a more prosaic version of the Hamad comment, right? Which is stories at the forefront can be priced on sizzle. Stories that are 10 years old are going to be priced on fundamentals. If they have 200 million in revenues growing at 20%, they'll be priced at 5 or 6 times. If they have 300 or 400 million growing at 30 or 40%, they'll get a decent 7 or 8 multiple, right? I don't know because I haven't seen the data. It's hard to get to scale in these markets. You have the dynamic of Microsoft at all times. There was a period of time when all those companies felt euphoric, right? And, it felt unbounded for Notion. It felt unbounded for Airtable. And then a little bit the tide went out of the productivity tools market. A little bit Microsoft just started grinding away at everybody as they've done in so many other markets. And then the world's moved on to AI. So now these are perfectly good companies that are just going to have to find fundamental value based on, revenue multiples and even, God forbid, free cash flow.
I think it's for what it's worth. I think just like there was a time when you weren't allowed to talk about Web 1.0 anymore, it just didn't matter. I think we can't talk about 2021 valuations anymore. It's time to just flush them down the toilet. I wrote down everything, I guess a year and a half ago, whatever. I wrote everything that had a hint of froth. I have one deal I'm still carrying myself, right? Because it's over 300 million in revenue and growing. I'm holding it as 2020, but I'm not going to 12, whatever the Lord says at 12/31, I'm marking it down this year. And it's time to just forget about those valuations. It's just forget, just pretend they, maybe you can't pretend, mark them down, even if they're personal, and just forget about them because it's too far in the past now. 4 years, it's time to move on from those decacorns of 2021. Klarna was 40 billion, right? Time to move on. Time to move on.
Its peak was 45. Sequoia, which SoftBank did. Sequoia brilliantly did the round at 5 or 6. And obviously 2 or 3x that, and I think overall 7x their overall investment.
I think we're not allowed to talk about these rounds anymore.
Agreed.
I think we're getting it, but we're getting at the end of this year. This is you've got 90 days left to kvetch and complain about your 2021 valuations. And on January 1, 2026, no one is allowed to talk about their 2021 valuations.
The only
any
problem
longer.
with not talking about your 21 valuations, Jason, is that we seem to be determined to make exactly the same mistakes in 2025.
Yeah, we need the runway to make them again, Rory. We need to focus on making the same mistakes again and not be hampered by them in the past.
Okay.
I'm seeing less diligence now than I did in 21.
There's no diligence, Harry. There's none. Maybe. There's on any hot AI deal, there is no diligence provided, nor is any done, right? It's just done on Saturday. Why would you do diligence? All you can lose is one extra money. Why would you do diligence?
Again, you can say what you like. As long as you don't put this quote out under my name, Harry, I'm happy. I mean, look, we're finding, again, to be the boring guy here, we're finding that what you have to do is you have to do your due diligence prior. Right, you have to come to the table with an informed opinion, which you can either pull out of your ass or try and do some pre-work. Right.
One of my companies had a term sheet pulled. This is a large company doing a lot of revenue from a tier 1 firm. And what I found more and more is just to kind of get the exclusivity and to lock the deal down, they'll term sheet it. And then for deep work, they're like, I'll do it after in the 30-day closing period. And then they pull. This is a really bad trait of an increasingly competitive
I'm less critical of it now than I was all the prior years of my career. I'm less critical of it.
That's pretty fucking bad.
No? What? I know, but here's my view, Harry. If you're only giving me a Saturday afternoon to make a decision, if you're giving me 1 hour, you won't share any data. A lot of these contracts are paid pilots. You're not disclosing anything, and you want me to make a decision in 5 minutes. Either it better be effing solid. Okay. And if immediately after that term sheet, I see 10 things that aren't true and you want me to not rescind my term sheet, you better let me dig in here because the level of trust that you have to do a deal on a Saturday it's under discussed. It is mocked by many, including leading accelerators, but there is a high degree of trust involved in this. So if you want people to make a decision in 5 minutes, it better be on the up and up. And so I used to be critical of it here. I used to think it was holding my place and bad. And it still happens. Like that's your point. It happens. It's bad practice, but I have a lot more empathy than I've done the last decade. I have a lot more empathy in 2025.
Or just do what we do, which is say, if you want that decision timeline, that's not our type of deal. Sorry, we're not going to engage.
Yeah. But I think many firms looking at, many of the best companies don't provide that flexibility today. They don't. It's literally now the best founders wind them up, right? Give them breadcrumbs and give them data ahead of time, right? If you want a big check, you got to do that. But when they're ready, it's 1 day, dude. It's 1 day. You can say no, Harry, but you're an aggressive investor. You're going to say yes to a couple. I'll bet you that SaaS tattoo. You're going to break your rule a couple times, but it's the right response, right?
Dude, I'll get a SaaS tattoo if Rory gets one.
Well, then you're fine. I plan to die with my body unblemished with tattoos.
It's not just being founder friendly. Anyone that's been a founder wants to be founder friendly, right? I want it to be an extreme, but not allowing diligence for all intents and purposes, you're running a risk.
Have you got less founder friendly?
Less founder friendly? I am more founder friendly, but it is less appreciated. By far. I am the most founder friendly I've ever been in my career. And it is, I get less, I catch more crap for it because everyone says great job and everyone's jostling behind the table and everyone's manipulative and I'm the only, and yeah.
Poor Jason.
No, you asked the question. Founder friendly is bullshitty as pulling the term sheets in 2025. It's both founder friendly has become bullshit, right? And, but it's table stakes. It's table stakes to get into the deal. You got to be founder friendly, right? Founder friendly is writing the check when no one else does. That's founder friendly. That founder friendly is when no one else is there at the board meeting anymore and you're there and you still have a W on the other side of it. That's founder friendly. Founder friendly is when you actually recruit the executive for the role, not just say, who are you looking for? I'll send it to my talent person and do nothing. These are things that are founder friendly, right? Not saying great job, no matter how you do.
Funny, I find myself oddly agreeing with much of that. I mean, what I've internalized is no matter how, in the game of founder friendly, it's not a winnable game. So what I say I'm trying to be is founder honest. I want to be founder honest, which is I want to tell you exactly what I think, which I think is more useful than great job if it's not doing a great job. Right. And I think you're right, Jason. The only way to judge who really is founder friendly is how they behave in a tough deal. There's no information on how you do in a good time. Right. And I've just internalized that most people don't check that. And that's just the way it is right now. Right. And So it just becomes this you end up with this meaningless trying to prove something in a bull market that you really only will demonstrate in a bear. But that's okay.
I am just going to say this before we do a Kalshi quickfire because Jason won't. But I always remember the RevenueCat founders telling me about Jason like wiring the money from like his personal account, and it's just like, whoa, there's.
Totally. I remember that. It was the SVB weekend. We were literally on Sunday having a partnership call, doing a whip around to say who could cover which companies when the recap came in and the US government stepped up. But yeah, it was interesting that you only know what people are like in a tough deal. It's also true, by the way, on VCs. You can only decide which VCs you really like when you've been through a tough deal with them, because then you know. Anyway, we got a Kalshi.
We're going to do a Kalshi quickfire. So, bets on when will a final TikTok deal be reached between the US and China? Come on, Rory, you love this round.
I hate this round, as you know, but I'm going to vote for never because it's just so much fun for the big guy to keep dangling it. This is I'm being slightly glib here, but planning to do the TikTok deal has been the most fun anyone's ever had because you have favors to throw people, et cetera, et cetera. Look, I'm sure it'll get done at some point, but it's not knowable by me.
Look, I obviously there's a lot of complexity here, right? But I'm going to say the next 60 days because I think the definitely somewhat toxic H1B stuff. This is a lot of tariff posturing too to get these deals with China and India just done. And I think they're going to get done. And so whatever this crazy deal is, it's going to get signed in the next 60. I think these deals are going to get done this calendar year, and I think it's going to get signed. And I think hopefully this H1B thing kind of diffuses too, because now it's not for existing. Everyone had to friggin' fly back in 24 hours, right? Now you don't have to do that. And a lot of these things may kind of evaporate as the tariffs get resolved. So I'm betting 60 days.
Meta smart glasses, another fail for VR or mega success?
0% chance they're a success. What's the bet?
Wow, why?
Because I owns like 8 pairs of the existing ones.
The Luxotticas.
No, the Meta ones that already work, that are light and work. Because we just don't need to play Tron in our eyes. We just don't need a 7th screen. It's another solution in search of a problem, in my opinion. We just don't. There's just only so many times I need to be on the podcast with Harry, looking at my notes in the size of my like 11-inch thick Gen 1 new ones. It's not a huge problem in the real world.
Oh no, I think it'll be a success.
These thick, huge things that you saw.
As you look to
I'm buying several pair. Don't get me wrong. I'm buying several pair.
I'm just like, if you look to disintermediate a phone and actually have a life where you can unify computer and vision and living, yeah, that makes sense. No,
I think in a typical VC lifestyle, it makes sense. I think for the normal world, we're not looking to. I mean, look how successful ChatGPT is. It's the same paradigm we've been using since forever.
It is, and look at Johnny Ive coming out with a device.
We'll see.
We'll see. It's as risky as the Meta AI glasses are. It's just risky. It's just risky.
But you were certain, Jason, they would work.
What's that?
You were certain that the hardware device that Johnny Ive's working on would work.
I think I think there's so much thought and energy put into this one will create the additional paradigm. But you just asked my opinion. I don't think the AI glasses, as someone who owns at least 6 or 8 of the existing ones, right? I just don't. I think it's rushed. I think it's clever, and I don't think it solves the problem. I do think I'm having fun. I'm watching what Johnny Ives from his new $70 million Tiburon Peter Terry just bought with his shares to add to all of Jackson Square. Because I think he's going to come up with something disruptive. And I think it's fascinating because it's such a hard problem. We just don't need only so many of us want to wear 2 smartwatches. Like there's just it was hard enough to get the changing this paradigm has been tough in tech. So, and a lot of venture dollars will go into it per Harry, but in the real world, we leave them on the shelf.
Final one. Will Atlassian's buying spree pay off? They've got DX, they've got smaller ones, Cycle, Born, they just going and going and going on the M&A. Will it pay off and make them an AI leader again or not?
Slap in the gray. In other words, it'll help. Look, it's not going to make them, quote, an AI leader, but they're doing the smart thing that existing corporations do, buying relatively new technology all they have to do, they don't have to claim AI dominance. All they have to do is move their existing customers into a AI engineering management world, then the browser-based thing separately, and just try and stay vaguely relevant and defend the market cap and, grow the business 20%. If that's what leading is, then maybe. If it's, do I think it's going to make them the AI dominant coding agent? No. But it's, just trying to move the needle on a 4 billion revenue, 40 billion market cap company.
No, it's not enough, right? I think you got to put chips into play, and I think it's just baby steps. I also thought, I look for these signs like what Sam Altman's saying, right? The other thing on the DX one, I looked. These are not easy jobs that like Michael Cannon-Brookes has, right? These are not easy jobs, and the PR pictures of him on the deal were him just alone. It wasn't even with the DX founders. Just this lonely picture of Michael, and I just thought, man, this is a tough job he has one of the great iconic properties of all time, right? In sort of, somewhat developer focused B2B software, but it just the lonely Mike in these pictures. I'm like, man, this stuff's hard. So if this was going to change Atlassian, they'd be together, toasting rather than the kind of wartime Mike picture. So I think it's a start, and dilution aside, or I don't know, I should know whether they did it with cash or stock. Make the bets. I don't think this is going to change the face of the company.
Combination, yeah. Guys, listen, thank you so much for doing this, as always.